We're jumping straight into interactive strength today. Everyone is watching the price action, but the real story is the 1 for 10 reverse stock split and the unusual volume we're seeing.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of this setup, make sure to subscribe and hit the like button. We're here to simplify the complex machinery of the market for you, and you definitely don't want to miss what we've got coming up.
Right, so let's set the scene properly here. We are looking at a classic high-voltage microcap situation. It's late February 2026, and if you were running your scanners on Friday, February 20th, interactive strength probably lit up your screen like a Christmas tree.
Oh, it was hard to miss. We aren't talking about, a casual uptick or a little bit of drift.
No.
The volume was just unusual. There was real activity, real gaps in the price action. And usually when you see a stock trading for penny suddenly waking up like that, scratching and clawing for attention, it's either a takeover rumor, a bankruptcy leak, or...
Or something technical is about to break.
Exactly.
Right. And in this specific case, the market is sniffing out a structural change. When we see that kind of massive volume spike combined with the stock landing on a top movers list, it tells us one thing very clearly.
That people are paying attention.
Yes, traders are positioning themselves. But the immediate question for anyone watching, and this is the tricky part, is are they positioning for a breakout or are they positioning for the liquidity event that often comes with a reverse split?
That is the million-dollar question right there. Because it feels like a momentum play, doesn't it?
It does.
Like the day trading crowd saw the volatility, saw the ticker moving, and just piled in because action begets action.
It absolutely has all the hallmarks of a momentum play. You have these deep psychological factors at work here. Traders see the movement, they see the volatility, and they jump in to capture those short-term swings.
Just pure FOMO.
FOMO, plain and simple. Fear of missing out. You want to catch the wave before it crashes. But for you, the long-term investor, or even the swing trader looking for a bit more substance than just a quick scalp, we have to look past the noise of the ticker tape.
Right. We have to look at what this company actually does.
Because eventually, the momentum fades, the volume dries up, and you're left holding the actual business.
And that's where it gets really interesting to me, because I'll be honest, when I first saw the sector, I thought, great, another Peloton wannabe?
Yeah, that's the knee-jerk reaction.
You see fitness equipment, and you think, okay, another treadmill company destined to become a coat rack in someone's basement. But interactive strength isn't just churning out generic gear, are they?
Far from it. This isn't about commodity hardware. If you look at their portfolio, they are a developer of specialty fitness equipment. They are building a moat around specific high-performance niches.
A moat.
And moat is the key word here. In hardware, if you don't have a moat, you're just competing on price with massive overseas manufacturers.
Which is a race to the bottom.
A race you will lose. Every time.
So let's unpack that moat, because they have a few specific brands that really stand out. They aren't household names for the casual jogger, but they are huge in specific circles. First up, you've got Wattbike.
Wattbike is a massive name if you follow elite sports. These aren't your standard spin class bikes where you just, crank up the resistance knob and sweat to techno music.
Right.
These are performance tracking indoor bikes trusted by elite athletes. We're talking about the All Blacks rugby team, British cycling, professional football clubs.
So what makes it different? Like, why does a pro rugby player care about a specific stationary bike? Why not just use a regular one at the gym?
It's the data. Wattbike is famous for its polar view technology.
Polar view.
Yeah, it analyzes your pedal technique, how you apply force to the entire 360-degree rotation. It measures your left leg versus right leg balance.
Oh, wow.
It's essentially a lab tool. Pros use it to actually train and rehabilitate injuries, not just burn calories. It tells you if you're favoring your left knee after surgery, for instance. That's not something you get from a generic bike.
Okay, so that's an incredibly sticky product. If a pro team builds their training regimen around that specific data set, they aren't going to switch to a cheaper bike just to save a few bucks.
Never.
They need that consistency.
Exactly. The switching cost is high. That's moat number one. Then you have CLMBR. And I have to say, the design of this thing is pretty cool.
I've seen this one. It looks really different. Most climbing machines look like medieval torture devices to me.
They do.
Just these massive, clunky metal towers that scrape your ceiling.
Yeah, they are. CLMBR is known for its open-frame vertical climbing design. Most climbing machines block your view. You're just staring at a central pillar or a bulky console.
Right.
But CLMBR managed to engineer something that feels open. It sounds like a small design tweak, but for the at-home user who doesn't want their living room dominated by a steel cage, it's a really big deal.
It makes the machine approachable. It actually fits into a home aesthetic.
Exactly. And finally, there's form, which enters that smart mirror space.
Right, the smart fitness mirror trend.
But again, it's not just a mirror. The problem with the first generation of fitness mirrors, and we saw this with other companies, was that they were just screens.
You just watch a trainer and copy them.
Right. Form integrates resistance training. They call it studio and lift. So you have this digital ecosystem where you're not just watching a trainer, you're interacting with the hardware. You're pulling cables, you're engaging with the machine, and it's tracking all of that.
And this is the key point about their whole ecosystem, isn't it? It's not just about selling the metal and plastic.
Precisely. It's about the ecosystem lock-in. Once a user buys a watt bike or a CLMBR, and they start tracking their data, logging their climbs, or following a program on form, they are locked in. They become part of an immersive, data-driven ecosystem.
Which totally protects them from the cheap knockoffs. If I just want a bike, I can buy a cheap one online for $200. But if I want my data, my training history, and the specific feel of a watt bike, I can't just switch to a generic brand.
You're stuck in a good way for the company.
It's basically the Apple strategy applied to sweat.
That's the exact definition of a moat in the hardware business. You wrap the hardware and software and user experience so tight that leaving becomes a pain.
Yeah.
And that brings us to how they actually monetize this. Because cool gadgets are great, but do they make money?
That is always the question with these hardware startups. We've seen so many burn through cash and just vanish. So what's the growth trajectory here?
Well, the strategy is twofold. They are targeting both commercial markets, so gyms, hotels, performance centers, and the at-home market. And they're doing this globally across the US, Europe, and Asia.
Okay.
The commercial side is actually really important for stability.
Why is that? Why not just focus on selling directly to regular people?
Because commercial contracts equal volume. If you sell to a hotel chain or a premium gym franchise, you're selling 50 units, 100 units at a time. It's predictable.
Ah, I see.
Selling to consumers is fickle. Marketing costs are high, your customer acquisition cost eats into profits, and demand fluctuates wildly with the broader economy. Commercial deals anchor the ship.
Speaking of commercial deals, I saw a specific detail about Germany that really caught my eye. They're seeing traction with the Wattbike Air PRO units in premium gyms over there.
Yes, and that is a very concrete positive signal. The German market is known for demanding extremely high quality and rigorous engineering standards.
Sure.
So if premium gyms in Germany are ordering Wattbike Air PRO units, it strongly validates the commercial appeal of the product. It shows they aren't just relying on selling one unit at a time to a consumer for their garage.
Right.
They have that real B2B volume potential.
Yeah.
Proves the pro quality isn't just marketing fluff.
And that ties into the business model you mentioned earlier. It's not just selling the bike once, it's the recurring revenue, right?
It's the holy grail of hardware. The mix of premium hardware sales and membership revenue. You sell the bike, you get the cash up front to cover the manufacturing, and then you get the recurring revenue from the connected fitness subscription.
Which smooths out the lumpiness of those hardware sales.
Exactly. Hardware is cyclical. Subscriptions are forever if you can keep the churn down.
Now, there's another layer here. This company didn't just invent all these brands from scratch. They've been very aggressive with acquisitions. We saw a lot of activity in late 2025, October, and September filings, specifically bringing these brands under one roof.
That's the operational efficiency play. This is what we call a roll-up strategy.
Let's quickly pause and explain that for you listening who might not be familiar with the term roll-up, it sounds like a fruit snack.
Right. A roll-up is when a company buys up smaller, often complementary companies in the same sector.
Okay.
The idea is that individually these companies, Wattbike, CLMBR, Form, have to pay for their own HR, their own supply chain teams, their own accounting, their own marketing.
Right, a lot of redundant costs.
Exactly. If you bring them all under one umbrella interactive strength, you can strip out those duplicated costs. You run them with a shared backend, shared supply chain, and shared marketing.
So 1 + 1 + 1 = 5, theoretically. You save money on overhead and boost the margin.
Theoretically, yes. If you execute it right, you drive much better margins than if they were 3 separate companies. But execution is a very heavy word there.
Definitely.
Merging cultures, merging software stacks, merging global supply chains. It's where a lot of roll-ups fail.
Okay, so that's the bull case. You've got cool tech, a sticky ecosystem, global ambition, and a recurring revenue model built on a roll-up strategy. It sounds great. If we stopped the show right here, I'd be tempted.
But we have to talk about the elephant in the room.
We do. We have to pivot to the lowdown on the risks. Because you don't do a 1 for 10 reverse stock split just for fun. Healthy companies generally do not do this. Let's break that down. Effective February 24th, 2026, Interactive Strength is executing a 1 for 10 reverse stock split. For anyone listening who might just see the headline and panic or maybe get excited because the price suddenly looks higher, what does this actually mean?
In plain English, a reverse split consolidates shares. If you had 10 shares before, you'll have 1 share after. The price of that single share will be 10 times higher, theoretically leaving the total value of your holding exactly the same.
So it's cosmetic math.
It's cosmetic math. It's like trading 10 dimes for a $1 bill. You have the same amount of money, just in a different format.
Theoretically. But usually the market hates this.
The market hates it because of why it's happening. Companies usually do this for one main reason: listing compliance. Major exchanges have minimum price requirements. Usually the stock needs to trade above $1.
Right.
If your stock trades below $1 for too long, you get a deficiency notice, and eventually, if you don't fix it, you get delisted.
And getting delisted is essentially a death sentence for institutional investment. Big funds can't buy stocks on the OTC markets. They have charters that outright forbid it.
Exactly. So this is often just a procedural move to keep their seat at the table. It's survival. It's doing whatever it takes to stay on the big board.
But the market reaction wasn't exactly a champagne toast here.
No, and it rarely is. Shares were trading lower on the announcement. It signals to the market that the stock has struggled to maintain value organically.
Yeah, there's a psychological hit.
Huge psychological hit. It creates a risk of dilution perception. Investors worry that the company is struggling to keep its head above water, and that puts immediate pressure on the stock in the short term.
It's like admitting you need to tape the bumper back onto your car. It might drive fine, but everyone knows you use tape.
That's a very fair analogy. It cleans up the look, the stock price looks higher, but it doesn't change the engine.
Yeah.
And actually, there's a technical trading dynamic here too.
What's that?
When a stock does a reverse split, it often becomes a target for short sellers. They know the company is weak. They know there might be selling pressure from frustrated long-term holders who are just tired of holding the bag, so they pile in to drive the price down again.
That's that death spiral people talk about.
Yeah.
Where the price pumps on the split, then shorts attack, and it drifts back down to pennies again.
It can be. It's a dangerous cycle.
Yeah.
And that leads us to the financial health of the company. Because if the engine is strong, they can survive the split and climb back up. But right now, the engine room it's a bit of a mystery box.
It is extremely opaque, and opacity is a risk in itself. When we look at the data from the 2025 filings, we don't have explicit detailed figures for profit margins or a clear breakdown of cash versus debt right now. We're basically working with puzzle pieces.
And investors hate uncertainty. If you can't see the cash runway clearly, you assume the worst.
But we do know some things. We know their headquarters are in Austin, Texas. And here's a number that completely blew my mind. 26 employees.
Yeah, 26.
Wait, let's pause on that. For a company managing Wattbike, CLMBR, and Form, selling in the US, Europe, and Asia. 26 people. My local coffee shop has 26 employees.
I know, it raises a really critical question. Is this an incredibly lean operation that has mastered outsourcing and operational efficiency? Or is it severely under-resourced?
Right, there's a very fine line between lean and starving.
Exactly. If you have 26 people trying to manage global supply chains, 3 distinct hardware lines, software development for the fitness apps, and commercial sales in Germany, that is a massive lift.
It really is.
It suggests they are relying heavily on partners or that the internal team is stretched incredibly thin. Compare that to a competitor who might have thousands of employees. Now, granted, too many employees can be a problem too, but 26 seems incredibly low for a global hardware logistics operation. Who is managing the shipping containers? Who is integrating the software?
And they aren't just sitting still either. They are trying to close this sports tech acquisition.
Which just adds another huge layer of complexity. The filings mention structured financing and working capital loans related to these deals.
And structured financing usually sounds like fancy talk for complicated debt.
It often is.
Yeah.
It usually means higher interest rates or debt that has covenants attached, strings attached. Maybe they have to maintain a certain cash balance, or maybe the lender gets warrants to buy stock.
Right.
It brings us right back to the execution risk. Integrating acquisitions is hard, even for massive companies with thousands of staff and dedicated integration teams. trying to integrate the pending sports tech deal, manage the loan guarantees, and streamline operations with a headcount of 26. That is a high-wire act without a net.
If they drop the ball, the consequences are real.
Very real. If they can't integrate these brands smoothly, that debt burden could become heavy very quickly. In a high-interest rate environment, servicing debt on hardware that isn't flying off the shelves is a quick way to burn cash reserves. And if you burn cash, you have to raise more money, which just dilutes shareholders even more.
So on one hand, you have the potential for a fitness empire. A lean, mean fitness machine with great brands. On the other, you have a microcap with a tiny team, a complicated balance sheet, and a stock that just got major cosmetic surgery to stay in the club.
Which is why the next few weeks are so critical. We aren't just guessing here. We have clear things to watch.
Let's talk about that. What is the immediate trigger?
Tuesday, February 24th, 2026, the effective date of the reverse stock split.
So we wake up Tuesday, the price is higher, the share count is lower. What happens next?
We watch for a base building phase. Often, after a reverse split, the stock is volatile as the arithmetic sorts itself out and the initial knee-jerk selling subsides. You might see a sell-off in the morning as people panic and say, get me out at any price, but then you want to see where the floor is.
So don't just jump in because the number looks bigger.
Correct. You want to see the price stabilize. Microcaps use this phase to try and attract institutional interest. Big funds often can't buy stocks that trade for pennies, but by getting the price up to, say, $5 or $10, they become investable for certain institutions.
Okay.
But those institutions won't buy until they see the floor hold. They need to see that the death spiral isn't happening. They want to see the stock trade sideways for a bit, proving that the selling pressure is gone.
Okay, so we're watching the chart on the 24th and the days after. We want to see volume dry up a bit and the price hold a level. What about the fundamental side? What are we watching there?
Future filings. We are flying a bit blind on the exact financial numbers right now.
Sure.
We need to see the Q1 2026 filings. That will be our first real look at how these acquisitions are actually being integrated post-split.
You need to see if those 26 people are pulling it off.
Exactly. We need to check the cash burn. Are they spending more than they are bringing in to support this structure? And we need to watch the pending sports tech deal. There were mentions of remedies regarding financing to unlock the European market.
Remedies, that sounds like legal trouble.
Basically, fixing issues to get the deal closed.
Yeah.
Maybe renegotiating terms or securing specific financing guarantees. If they successfully pursue those remedies and close that deal, it opens up Europe even more. It proves they can execute a deal. If that falls through, it's a big stumbling block. It would suggest that the roll-up strategy is hitting a wall.
And zooming out, what about the macro view? Because people aren't exactly throwing money at $2,000 exercise bikes right now.
The macro is interesting right now. We're seeing some sector rotation. Is money moving back into consumer discretionary?
I mean, people have been tight with their wallets lately, inflation and all that.
They have.
Yeah.
But wellness is a very sticky trend. It's one of the last things people cut. If rates potentially get cut later in 2026, or if consumer confidence ticks up, premium equipment is one of the first things to benefit. You have extra cash, you upgrade your home gym.
Right.
So if the macro winds shift in their favor, that demand could spike just as they're getting their house in order.
That would be the perfect storm. A cleaned up stock structure, a closed acquisition, and a consumer ready to spend.
That's the bull scenario. And frankly, with a microcap like this, that scenario can lead to explosive growth. But the bear scenario, where the debt drags them down and the integration fails, is equally potent.
So here's the lowdown, the ultimate trade-off. You have a company with a genuinely strong patented product portfolio. Wattbike and CLMBR are legit pieces of engineering. They aren't junk. You have a clear path to European expansion. But on the other side of the scale, you have the technical volatility of a reverse split, the opacity of a microcap balance sheet, and a very small team trying to do very big things.
That's it, perfectly. It's a high-risk, high-reward setup. You're betting on the products and the efficiency of the team to overcome the financial engineering hurdles.
It's certainly not boring, and that's exactly why we watch it.
Not at all. It's a classic turnaround play.
So I want to leave you with this final thought to chew on. We see the reverse split, we see the debt, we see the tiny team. Is the reverse split a sign of distress? Or is it the necessary housekeeping required to clear the deck for a massive institutional breakout in 2026?
Is the question.
Thanks for tuning in to the Easy Money Show. We'll be watching the tickers on the 24th right along with you.
See you then.